when you're ready.
Okay, I did the adjustments for accrued salaries, and a few things you need to know, like, so you can like understand what you're doing, is the salary expense, which is just like the salary that you pay to your employees, and then salary payable is like the salaries that you owe to your employees.
Can you move a little bit like backwards, please, Chris?
Yes.
Thank you.
And then for the adjustment, you do like the adjustment when you're paying the salaries in the next period, so like in the next year. And you just debit salary expense and credit salary payable for whatever the amount is. And then here's an example. I've got arrows pointing to salary payable and salary expense. And now could you all get out your demos, please? And this one is on the letter H, and it's accrued salaries total $2,000. So on line 17 is salaries payable and 23 is salaries expense. So you're gonna debit salaries expense for $2,000 and make sure you put the H. And you credit salaries payable for $2,000 and also put the H. And that's it. So are there any questions or anything? Okay.
Yeah, Chris. You're Chris. Happy time.
Oh, hey, you got put it on the.
Sorry, now go.
I did the adjustment for honor and rental income. So some corporations will like rent space to other businesses in order to increase their revenue. Like lease agreements may require the business that's renting to pay in advance. The unearned rental account is a liability. So when I first received the cash, they debit cash and credit unearned account. So the adjustment for it at the end of the year, you debit unearned rent and credit the rental income, and then to calculate the amount that you're adjusting, you just multiply the months that they rented by the number of months, or the monthly rent by the number of months that they rented.
Can you slow down a little bit?
So,
I think you're going a good speed, Kyle.
Take a step to your right and stop it. Step to your right.
Alright, so for example, if you rent space for like $2,000 a month and the business pays advance, you pay $24,000 total, and then this is March 1st, so the adjustment would just be $20,000.
Wait, why is it the 20,000?
Because you take the amount of months that they actually rented over 12, and you multiply by the amount that the monthly rent.
Okay. So that's because it's like just from March to the end of the year,
Yeah.
and then you do the same thing for the next year.
Yeah.
All right.
And then if you'll take out your demos, so mine's demo says rental income of 1,200 that's been earned in this period. So on line 18, you would debit 1,200, just unearned rent, and then rental income, you credit that for 1,200 on line 26. That's all I know.
Yeah, Kyle.
Okay.
Alright, so this is a adjustment for federal corporate income tax. Right, it's like to calculate, you have to total all the other adjustments, so add them up. You have to add all of them up. Then you need to calculate the income before taxes. So you take the debit column versus credit minus the credit column minus the debit column. That will give you the income before taxes. And it is used to determine the tax amount of how much, and then you take that number, total income tax minus taxes already paid. That gives you the amount that you need to pay, and then that will be your total amount for your adjustment for federal corporate income tax.
And is the total just like the tax bracket?
Yeah, it like the total income, there's like a tax bracket that you have to pay. That's based off of your income before taxes. So that's why you need to find out the income before taxes. Then you record the entry, and it's adjustment federal corporate income tax expense is what you debit, and income tax payable is credited. So, in all the problems we do, it will basically tell you the amount, and it will, so we know there's a difference, but in real life, you might wonder how there could be a difference between how much tax you paid, like how much taxable income you recorded versus how much actual taxable expense has been recorded. So the net income and taxable income could be calculated differently. So like, say there's depreciation expense on assets, like on the income statement, you could use the straight line method versus whereas on the tax like statement, the taxable income, you could use like sums of the year digits. So in the end, like in the first couple of years, it might be different. So there'd be a difference you have to adjust there. So another way is that you could record revenue on one but not the other, like on the income statement. So like interest on municipal bonds would be included on the income statement, but it's not included in taxable income. So there'd be a difference in the businesses. And the other way is that expenses are recorded as one thing but not the other. So an example is like research and development is recorded as an asset on the statements and as an expense on the tax return because you have to pay money to do research and development, but for the company it's benefiting you to do the research and development. And then this is the statement that was on Applia. If you notice at the top here, it's federal income tax payable. And then at the bottom here, it's federal income tax expense. So that just kind of gives you a general awareness of where they're located on the total balance sheet with all the accounts. So now we'll do the demo. So if you turn to your demo, well first, is there any questions before we get to the demo?
What were all the different methods you could use?
The different methods was, like I said, like the depreciation, like it's a depreciation or appreciation, so you can use straight lines, some of the years, digits, etc. Any other questions? Alright. So in the demos problem, it's J, and it states that we still have $300 left to owe. So that's the amount we record. So you write J and you debit the expense, which would be line 28 for 300.
How much?
$300. And then you'd credit the payable, so it'd be 916 federal corporate income tax payable for 300. And so some people, like the businesses, won't know how much the federal corporate income tax is. So what you'd have to do if they do not give you that amount is you'd have to total the like adjustment columns and find, but you want to add right at the bottom, you'd do it on like a separate sheet of paper, you'd add all the adjustments together. And then you'd subtract that from the number they give you, which would be in their tax bracket, how much total tax they paid, and the difference would be the amount you record. Thank you.